to The Money Manager. I'm Lindsay Williams in Cape Town, and in Johannesburg is Dr. Adrian Saville from Cannon Asset Managers. We're going to talk about Superdogs now. Now, Superdogs is something that is for people who like things that are aggressive. A small amount of your portfolio should be aggressive. It's all to do with undervalued stocks, and it's all to do with the long term. So this is, I suppose, Adrian, like you go to the SPCA, so you buy something that's undervalued. It's a pit bull. It needs a long-term lot of training, but of course we know it's aggressive. Similar thing.
The reference to dogs is not that these are mongrels or unloved street animals. Instead, the reference to dogs is really to investor sentiment, that investors have fallen out of love with animals that very often have some quite superb pedigree. And whilst it can be the case that it takes a little while for that pedigree to be recognized, sometimes the pedigree can surprise in a very short space of time. As a case in point, a stock in the portfolio called Silverbridge is up more than 100% over the last 12 months.
Let's have a look at that portfolio now, because there are going to be Superdogs, and I would imagine a couple out of your portfolio that will be permadogs. But
Sure.
On the other hand, the example that you just alluded to probably sort of outweighs the couple of permadogs. So it's probably, you've got a good chance to get a 10, 15, 20 bagger, or even a couple of them over the years. What's been the history of the portfolio performance-wise for a while?
Well, Lindsay, the portfolio goes all the way back to the mid-1990s when I started constructing it, and over the almost 20 years of its history, the JSE has done just over 10 times money. This has done more than 30 times money. If you're worrying about year-to-year performance, it's probably not the right place to allocate your capital. But as a case in point, last year the portfolio did just over 20% versus the market's 10%. And there is absolutely no assurance that you're going to get these superior results or better investment returns without lower volatility. You have to be willing to tolerate walking away from the market and owning a portfolio that looks very different to the market. And your point about the permadogs and the 10 baggers, I think, is well made, because we use a screening process to construct the portfolio where the screen is disciplined and repetitive, and it ensures that we've got a well-diversified basket of names in the portfolio at all times. And sometimes those names are well-known businesses that have just fallen out of favor. Examples from recent times would be the Imperial Group or Old Mutual, so they can be quite big businesses. And other times they are really just this absolutely superb buried treasure. And examples, again, from recent times would be a company like OneLogix, which over the last 10 years has done 30% top line and bottom line growth. And it's translated into the share price moving from less than R1 to almost R6 at current in the space of 3 years.
I'm very encouraged by this, because if you, for example, look at the London property market, there's no way, with the dissemination of information and the distribution of information there is now, internet and everybody looking at a particular market that is quite buoyant, you can't find a bargain there. I would have thought that on the JSE, being a relatively small market, there are so many people looking for so many of the 10, 15 baggers that I spoke about earlier on, that there are no bargains out there. But you're saying that if you actually dig around, some of the big fund managers, the bigger fund managers, you're big, but there are people that are bigger out there, wouldn't even look at some of the stocks that you're looking at, but they are there. There are the buried treasures that you spoke about.
Yeah, absolutely, without question. There are always these hidden opportunities, buried gems, and examples in the portfolio at the moment. I think Silverbridge is an interesting case in point. Notwithstanding the fact that the stock is up 100% over 12 months, it still trades on less than 10 times earnings. Another example would be a company, Marshall Monteagle. And when you mention the name Marshall Monteagle to many South African market followers, they've never heard of the business. Yet here is a well-established, reasonable-sized company, 450 million market cap, and it's trading at less than net asset value.
Very good. So what sort of person invests? I know the minimum investment is 200,000. How much of a meaningful stake can you take in these companies? Lots of questions. I know it's not going to be 30 or 40% of anyone's portfolio because of the nature of the companies. 450 million market cap is not very big. But on the other hand, if you can get 5 or 6% of your portfolio in some of these things, and you can get 3 times the performance of the JSE, then well done.
Yeah, the liquidity is an important consideration. The portfolio happens to be relatively well diversified, more than 30 names, which means as a rule of thumb, you can think about each stock making up about 3% of the portfolio. So we're not talking about allocating all of the portfolio to a single company or even a large chunk of the portfolio to a single company. How much could or should an investor allocate to this portfolio? I think it really has to be assessed on a case-by-case basis. I think I've made this argument to you before. 2 of my most successful clients in this portfolio are my son and my daughter. And my wife Kerry and I put them into the portfolio 8 years ago, and they haven't asked any questions so far. They're fantastic clients, and all of their capital is allocated to the portfolio because they're 11 and 8 years old, so they've got very, very long runways. If they were 80 or 70 years old, then you probably wouldn't want to be allocating 100% of your portfolio to this. So I think it's a function of the size of your balance sheet, the length of your runway, and your just your willingness, your appetite to tolerate deviance from market.
Let's talk about the composition of the portfolio. You've spoken enthusiastically about a couple of stocks. Tell us let's call it your top 5.
Well, let me talk about 2 of the financial businesses and 3 of the industrial businesses, and that'll give us a short list of 5. In the financials, 2 that really stand out to me are Saville, which has been a long-standing investment held by Cannon across a range of our portfolios. But what I really like about Saville is its uninterrupted dividend history. When you're looking at a bank, you want to assess the value of the bank relative to its balance sheet. Saville trades at a fraction of the multiples of the other listed banks. It's been around for a lot longer than many of the listed banks, and its profitability is higher than the banking industry average. We think that it has a lot of runway ahead of it, and it's helped by the fact that Saville isn't trying to be all things to all people. They really know what their business is about. I think another interesting...
That's what I was going to ask actually, Adrian. Sorry to interrupt, because
Sure.
Saville's always there, and we speak to David Shapiro. I've spoken to David Shapiro earlier on my market report, and they have good people, and they go about their business in a dignified and sort of organised fashion. But what are their aspirations? Are they always going to be Saville, paying dividends, or are they going to become something bigger, get bought by somebody? What are your thoughts?
If there is an appetite to buy a South African bank, whether it's an internal buyer or an external buyer, I think this is one of the more interesting prospects in the South African environment. FirstRand trades at 2 times the Saville multiple, yet Saville is more profitable relative to the size of the asset base. So if you're looking for good businesses at good prices, Saville really stands out to me. I'm not in a position to talk about what I think their aspirations are, but they're small. It's a big market. They've got some very powerful competitive attributes that make for a good business.
Stock number 2.
A second financial company that I think is worth looking at, and this is also a business that we've spoken about for a little while, is Conduit Capital. Conduit also is held across a number of Cannon's institutional portfolios. And what first attracted us to Conduit was they were what Benjamin Graham all the way back in the early 1900s described as a net-net, where the cash on the company's balance sheet, effectively owned by shareholders, was worth more than the company's market cap, meaning you were being paid to buy the business. It's profitable, it's dividend paying, and when we made the original investment, it was a net-net. That was a couple of years back at around 70 cents a share. It's now up more than 100% from that, and whilst the share price has moved up this 100%, the profitability of the business and the balance sheet have continued to grow, and so they've remained profitable. They did suspend dividends for a period, and Jason Druin's board recently resumed dividends, so we're back in the position of being dividend paying. And we love dividends because I think they remind executives who the owners of the company are and who they're working for. So those are two, I think, very interesting financial businesses.
So we've got to go on to industrials now. You've got 2 minutes left on this one, so run through them quickly, but just give the main points. But I like your dividend policy. Carry on, please.
Sure. Well, in the industrials, 3 quick names to give. I'll go back to Silverbridge, which is a entirely off-the-radar software business. They provide software services to the insurance industry, and out of this generate relatively sustained, robust revenue, trading on 8 times earnings, despite the fact that the company is up 100% over 12 months. Having said all of that, it is a tiny market cap, and it's going to be off almost all investors' radar. So I think this is really for the investor who's willing to look where others are just not looking at all. It's a smaller than 100 million market cap. OneLogix is another interesting one. I've also made reference to them. Their earnings, they reported last week, up just early double digit, but in a tough economy and ahead of peers if you think of comparators like the Imperial Group. And OneLogix has got a great business portfolio under Ian Lawrence that just continues to impress us. And then perhaps a packaging company that's off many investors' radar but has been around for years, Transpaco, which is listed in the 1980s, has a long uninterrupted profit history. It's entirely unwatched, overwhelmingly unknown, and it's a great stock to put into your bottom drawer and leave there for a very, very long time.
Adrian, thanks so much for that. But before we go, just one thing. Are there other Superdogs out there? Are there 2 or 3 that you're looking at without giving away any secrets?
There's always Superdogs, and sometimes they come, just as a result of a surprise that the market gets some news that distresses the market but doesn't change the fundamentals of the business. As things stand, we're happy with the portfolio, but we're always looking, and no doubt something will come onto our radar and into the portfolio.
I said that was a final question, but I've got the final question now. If it's a large cap company, let's say it's a platinum company that starts trading at a 3.5 or 4 PE, would you put that into Superdogs because it's unloved?
I'll give you an economist's answer, yes and no. The Superdogs portfolio only holds financial and industrial companies, so we don't hold any resource businesses. And there's some science behind that. Given our short time, I won't go to that science. But if it were a large cap business that fell onto a very attractive multiple, without question, we would put it into the portfolio. And a great case in point is Old Mutual, which in the global financial crisis fell to 30 cents in the rand relative to the embedded value of the business. It was a fantastic opportunity. We took as much Old Mutual into the portfolio as we could, and from 2008 to now, Old Mutual is up 6 times.
Adrian, thanks so much for your time this evening. That's Dr. Adrian Saville from Cannon Asset Managers talking about Superdogs, and the tail is wagging for the Superdogs portfolio.